Hi everyone. In the fifth part of this question, we need to calculate after-tax cost of debt. After-tax cost of debt reflects the effect of interest tax shield. Therefore, after-tax cost of debt is simply the pre-tax cost of debt multiplied by 1 minus tax rate. Consequently, after-tax cost of debt is 5% multiplied by open bracket 1 minus 30% close bracket. This gives us after-tax cost of debt of 3.5%. It is obvious that after-tax cost of debt is always lower than pre-tax cost of debt. Because after-tax cost of debt is pre-tax cost of debt multiplied by 1 minus tax rate, which is always less than 100%. After-tax cost of debt will be equal to pre-tax cost of debt only if tax rate is 0%. Thank you for watching this video.